Hi, everybody, and welcome to our fourth quarterly investor call of 2022. And thank you for joining us today. We will be hosting a question and answer session at the end of this call, so please use the question or chat box to submit questions to Justin, Peter, and Dominic throughout the presentation. We will address all questions at the end of the call. This call is being recorded and will be available for replay by visiting our website, clicking on the resources tab, and then clicking on quarterly investor call. You can also find the call on our new YouTube channel. Before we get started, we must remind you that the purpose of today's call is educational and the material presented is publicly available information from sources believed to be reliable. The information in this presentation may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice or recommendations to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. This call will be available for replay on the O'Keefe-Stevens Advisory website located under the Resources tab or on our YouTube channel. Please contact us if you would like a link to the recording of this call or any previous calls.
Thank you, Carly, and good afternoon. Thank you all for joining us today. Market volatility continued during the third quarter, and across many measures, we saw investor fear and pessimism increase to levels even greater than the 2008-2009 financial crisis. The Federal Reserve's hike of interest rates and soaring inflation sent the broad market down in August, sometimes for several consecutive days. And in the big scheme of things, we just don't see this level of bearishness very often. If you're holding on to any significant cash for any serious long-term goals, we are recommending that this is a good time to deploy it. So after my market and economic updates, Dominic is going to spend some time discussing the opportunities that we see in the markets today. Prices are way down across many sectors, and our watch list of companies is full of compelling opportunities. And Peter is then going to discuss the changes that we made to the portfolio during the previous 3 months and give you some insights into what we see in these businesses today. The two new companies he's going to cover are TriPoint Homes and Lazard. And then at the end of our call, we'll field any questions that come in. Again, you can type in your questions into the chat box at any time during our remarks, and we'll address those questions in the order that they are received. So the stock market, as measured by the S&P 500, is down 25% through the end of the third quarter. International company stocks fared even worse, and even bond investors are losing value, with the U.S. aggregate bond index being down 14% through the end of the third quarter. Today's market results across all asset classes are some of the worst we've experienced in decades, and these results, while shocking to see when you open your September statements, are not overly surprising to us, as we expect a decline like this to occur once on average about every 5 years. And when you consider that over the past 3 years, the overall market grew by 18% annualized, the fact is that we are now giving back some of the gains that were the result of our Federal Reserve's actions to stimulate spending and pull the economy out of the pandemic recession in 2020. As we've discussed before, the Fed money printing actions are finally catching up to us, and now it's becoming necessary to slow things down. There are still record amounts of cash in bank accounts and on corporate balance sheets, and this is putting pricing pressure on nearly all goods and services. And as a nation, we're experiencing inflation like we haven't seen in 4 decades. And the Fed is continuing to take action to deter more inflation by continuing to raise interest rates and bringing the economy into recession territory. This type of an environment is creating a lot of defensiveness in the investment world. Investors today are jockeying to where they feel safe, but our feeling is that today stocks are becoming more and more likely to be the better returning asset class of the future. And as Dominick is going to discuss later, the price of companies relative to their earnings are now at the levels that we think are much closer to historic norms compared to their elevated prices that we saw at the beginning of the year. Continuing with the thoughts I shared on that last slide, the problem of volatility dissipates the longer your holding period is. So this chart illustrates that in a single year, the variance of outcomes, whether you hold stocks, which are represented by the green bar, or bonds, which are represented by that blue bar, that variance is quite wide. If a year is your time horizon, we could easily make the case that stocks are not the right vehicle for your funds. As you cross into the 5 and 10-year holding periods, you see that the return profile of stocks starts to skew much closer to the stability of bonds. And by the time you get to a 20-year holding period, stock returns are the clear winner in terms of both preserving capital and growing capital. Which brings me to my next point, the call to action to begin deploying cash for your long-term goals. This chart shows the history of bank returns and inflation. Those of you who remember the early 1980s recall that during that period of soaring inflation, banks were paying depositors record high levels for savings accounts and certificates of deposits. And banks were also requiring double-digit interest rate loans to secure a mortgage at that time. But the savers of the 1980s were spared because they could securely guarantee low double-digit rates of return on their bank deposits or their treasury holdings. I gotta go back. If we look back or over to the right side of the screen, today, bank balances pay next to nothing, while inflation is starting to rise to the levels that we haven't seen since the early 80s. Cash is not a good place to hold any serious amount of longer-term funds. It's only suited for your emergency reserves and day-to-day cash flow needs. The big question that we're getting today is whether or not we are actually in a recession. The economy has contracted for 2 consecutive quarters, which is the typical requirement for a recession, but no announcement has been made by the National Bureau of Economic Research, which is who ultimately declares when we are officially in a recession. Part of that hesitation might be that unemployment is still at historic lows, or that corporate earnings continue to grow despite share prices and businesses contracting. So this slide shows that since 1970, there have been 8 economic recessions. Those are the gray shaded bars that you see on this chart. We either are or are not currently in the 9th recession since 1970, and that's something we won't know for sure until the National Bureau of Economic Research releases their official statement. But let's just assume we're in the 9th recession. If we look back over these 9 recessions, we've learned that there is no pattern to the depth or duration of these economic contractions. The longest one lasted 18 months during the global financial crisis. And until COVID came about, that was also the deepest recession, with our nation's gross domestic product down 5.1%. Then came the pandemic in 2020, where GDP dropped an astonishing 19.2%, but that recession only lasted for 3 months. We are not going to attempt to make light of the significant economic impact that we all experience during these episodes. Every single gray bar you see on this chart was a time of crisis, and more importantly, no one could predict when, where, or why each of these recessions was going to end. And that brings us to today. We're in another episode of unpredictability, crisis, and market panic. The purpose in presenting this slide is to provide our perspective on some important developments that have taken place despite these previous 8 recessions, including the current episode that we're living through today. the beginning of 1970, US GDP, gross domestic product, adjusted for inflation, meaning that it's represented in today's dollars, stood at $4.95 trillion. Today, our nation's economic output is nearly quadruple that amount at $19.7 trillion, despite the 8 or maybe 9 economic recessions. And the individual American also fared pretty well during these expansions. Despite US population growing by about 70% since 1970, the GDP per capita or per person in the United States is up more than twice as much, from $24,300 in 1970 to $59,168 today. Meanwhile, the stock market, measured by the S&P 500 index of approximately 500 American businesses across all sectors of the economy, was at 92 in 1970. And today, even after the whipsaw of volatility during the previous weeks, it's at about 3,600, up 39 times despite these recessions. And the reason the stock market is up 39 times is rather simple and a fundamental point that we try to instill in our clients' thinking. It's because the earnings of those businesses grew by 39 times from 1970 to 2022. The S&P 500 earned $6.10 in 1970, and the consensus earnings forecast for 2022 is around $225. And the point is, in the long run, earnings always drive share values. Another important thing is the dividends of the S&P 500. At the start of 1970, S&P 500 dividends were $3.24. By the end of 2022, the dividend is estimated to be $65, or roughly 20 times higher. And the consumer price index, our measure for inflation, in 1970 stood at 38. Today, it's approaching 300, up 8 times. Now, my final point resides in between these last 2 points. What you see here is the cash dividend of the S&P up 20 times and the cost of living up 8 times. If your goal in your retirement is to keep up your standard of living while not running out of money, the answer is right here. It's dividends. This perspective is the one we're choosing to pay attention to today. It's easy to get caught up in the current situation and say, this time it's different, but all 8 of the previous recessions were different from one another. What they all have in common is that they were temporary. And at the end of each recession, economic growth, real GDP per capita, share values, and dividends resumed their upward course. So for the long-term investor, it turns out this is all that really matters. With that, I'm going to turn it over to Dominick and Peter to talk about research and portfolio updates. Dom?
Thanks, Justin. A year ago on the Q4 2021 quarterly call, I showed this table, which is an outline of some of the companies we have on our watch list. We maintain this list to monitor where stocks are trading and compare that to where we would ideally like to purchase them. When I showed this chart last time, there were very few bargains. The S&P 500 was trading around 34 times earnings, and there were signs of speculation everywhere. It's not surprising we didn't make many purchases last year. As I stated, these are relatively good businesses and ones we would potentially own at the right price. The problem with almost all of the businesses was the price we had to pay was far more than what we thought they were worth. However, a lot can change in a year. If we look at this watch list today, the price of these stocks have come down dramatically, resulting in an increased number of businesses trading at cheap valuations. The chart above is the same for the most part as the one on the previous slide, except the only thing we added was the earnings growth rates for the upcoming year that either we or analysts expect. For the most part, these companies have all been profitable for several years and have growing earnings. Comparing the watch list to the market, you will notice two things. First, the median earnings growth rate for our watch list company is 15%. This is almost double the expected earnings growth rate from the market. Additionally, the median price of earnings for our companies are almost 33% lower than the market. While we have several companies trading at attractive prices, we must compare these to our existing holdings, most of which have also been beaten down and are much cheaper compared to the start of the year. Our familiarity with portfolio holdings also increases the certainty we have in them compared to ones on our watch list. You likely have noticed that the portfolio turnover has increased compared to last year. In general, we have been selling out of positions where we have either lost faith in management or disliked the direction the business is going in and reallocated this capital to companies that are moving in a direction that we agree with. Some companies continue to trade at rich valuations, though with the 32% decline in the NASDAQ this year, many of these once overvalued companies have come down to more reasonable valuations. We continue to be excited about the potential future returns of our portfolio as many of the businesses continue to grow and increase their value, even though their stock prices have gone in the opposite direction. During portfolio drawdowns and even during bull markets, I try not to look at the value of our portfolios shown on the screen as your actual wealth. Since we believe these securities we own are dramatically undervalued, I try to think about what the future value is when the stocks appreciate to our fair value estimate, and not focus on what the current portfolio value is. Therefore, as stocks decline and we continue to hold and add to positions, the future value and our expected return actually increases because we are buying these stocks at cheaper and cheaper valuations. Several of our holdings are repurchasing shares at these lower levels, which is also increasing the intrinsic value and our future expected return of the holding. While it's difficult in the moment seeing the value of your portfolio decline, as Justin stated, our future expected returns are higher today based on the cheap valuations compared to what they were to start the year. With that said, I'll turn the call over to Peter. He will talk about some of the transactions we've made this year.
Thanks, Dom. During the quarter, we made several changes to the portfolio, purchasing Lazard and Tri Pointe Homes while selling our holdings in Seritage Growth Properties and Franklin Resources. First, I'll discuss the sales, and then I'll focus my comments on our investment thesis for the acquisitions. Early July, we sold our position in Seritage. Since we made our initial purchase, Seritage became a very different company. The original management team is no longer with the company, and executive turnover has been far too prevalent. Additionally, the company has continued to sell assets to fund debts and make interest payments, along with ongoing capital requirements to develop their properties. The turnaround has taken much longer than anticipated, with COVID-19 playing a significant role. On July 8th, Seritage put out a press release stating its intention to sell off its entire portfolio over the next 30 months. The stock rose dramatically. After the announcement, we chose to exit our position and redeploy the funds into our other higher conviction ideas. Later in the month of July, we decided to sell our Franklin Resources. Our initial thesis was centered around purchasing an inexpensive business with a significant cash position, a solid and growing cash dividend, and the potential for consolidation in the industry, resulting potentially in Franklin being acquired. Since our initial purchase, instead of being acquired, it has been doing the acquiring, purchasing Legg Mason, Lexington Partners, O'Shaughnessy Asset Management, and several others. Franklin is on a mission to grow their alternative investment business, also known as private equity. We have been skeptical of the amount of capital flowing into private equity over the past decade, as these companies typically employ an uncomfortable amount of leverage and have tremendous flexibility surrounding the valuation of portfolio companies. Given these concerns, we're worried about what The wise do in the beginning, the fool does in the end. Franklin is very late in the private equity business, and it has been on an acquisition spree trying to grow these assets. Over the next decade, private equity will continue to be a more significant portion of Franklin's business, as well as its holdings in fixed income. These two investment classes concern us, with fixed income at lower interest rates and rising, and private equity for the reasons we noted above. Therefore, we chose to sell our position in Franklin, a business that is going in a direction we do not approve of, and into a business we're more comfortable. A significant amount of the sales proceeds were invested into Lazard and Tri Pointe Homes. Lazard is one of the world's preeminent financial advisory and asset management firms with over $250 billion in assets. It operates in 40 cities across 25 countries in North and South America, Europe, Asia, and Australia, and was founded in 1848. Lazard advises on mergers and acquisitions, strategic matters, restructurings, capital structure, raising capital, and corporate finance. The firm also provides asset management services to corporations, individuals, and governments. The recent decline in the price of asset managers, the Russian invasion of Ukraine, rising interest rates, the surge of global inflation have all been factors that have made this an attractive investment. Lazard is a unique organization with an outstanding history of profitability, and the stock is trading at the lower end of its historic valuation metrics. We're happy to own Lazard, an outstanding business with a substantial and growing cash dividend and prospects for capital growth. Also, during the quarter, we purchased Tri Pointe Homes, one of the nation's largest home builders, with operations in California, Texas, Arizona, North and South Carolina, Colorado, Nevada, Washington, Virginia, Maryland, and the District of Columbia. In 2014, Weyerhaeuser spun off its home building unit into Tri Pointe in a $2.8 billion transaction. We believe Tri Pointe is well positioned to benefit from the underbuilding of homes, which began during the global financial crisis. Higher interest rates and the potential of a recession have created what we believe to be an outstanding buying opportunity. At the price of Tri Pointe's common stock has declined significantly from its higher valuation. Tri Pointe's experienced management team has significant ownership in the business and has demonstrated significant long-term growth of revenues and profits. Carly?
All right, thanks, Peter. Now we're going to move into the question and answer portion of the call. It doesn't look like we have any questions submitted yet. So if you would like to ask a question to any of our team members, type it into the question box or the chat box. We'll wait here for a couple minutes. Thanks. All right, it looks like we did receive one question that's about NVIDIA and how that investment is looking. Peter or Dom, want to take that?
Sure. Why don't I comment first, Dom, and I'll let you add if you would like to add any other additional comments. NVIDIA held their investor day last month, and they've come out with a number of new products, and the power of their products has increased significantly as well. They also are developing a new gaming line, which is coming out shortly, and they also began for the first time developing a central processing unit, or a CPU, so that now will compete directly with Intel and Advanced Micro Devices, who are dominant in those companies. I would also like to make note that historically, if we go back over the 20 years since the GPU was invented, NVIDIA has had over 50% market share, and and they typically have, between them and Advanced Micro Devices, dominated that market. As of the most recent report that I've read, NVIDIA now has about 80% market share compared to the 20% for NVIDIA. And Intel recently announced that they're going to have a GPU. They also tried this about 12 or 13 years ago and failed at it, but they're have changed their mind, and they believe that the GPU is important. Another important point to bring forth is artificial intelligence, which we had a market of about $8 billion in 2020, is expected to be a $200 billion market by 2030. And now, given that about 80% of the chips used in artificial intelligence are made by NVIDIA, the long-term prospects continue to be very bright for them, although the stock price has been literally clobbered in the last 9 months, declining well over 50%. So in the period we've owned it since 2013, this is now the second time we've seen a more than a 50% drop in the price of that. I would also mention that one of the most successful companies in the history of the world, Berkshire Hathaway, I believe they've seen the price of their stock over the last 40 years decline by over 50%, 6 times. Dom, any additional comments?
The thing I'll say is just during the pandemic, a lot of companies over extrapolated the near-term or recent trends that they were experiencing. NVIDIA did the same thing, AMD, Intel, and even if you looked at retailers like Target or Amazon, they all overbought inventory relative to what the actual demand turned out to be. So in NVIDIA's case, and along with every other semiconductor company, they not only recently purchased too much supply, but demand specifically in the PC market has fallen off. So when you combine these two factors, it's been a bit of a hit to the company. The thing to note, though, is that NVIDIA continues to transform its business to more of a data center revenue model, and that business continues to fire on all cylinders, which gives us some confidence even during their worst periods of performance.
All right, we've got a few more questions coming in. The next one we received was, are you thinking of buying any more timber, oil, or mining companies?
Sure, I'll start that, Pete. We have recently purchased some additional timber companies, and a lot of the thesis on the timber companies, and even if we look at companies like 5 Point Holdings and Tri Point Holdings, they all center around the underbuilding of single-family homes over the past decade. So I don't think we're going to look to buy any more of those type of businesses because portfolios are typically full on those type of businesses. In regards to oil, we recently sold some of the positions, Tidewater and Devon, I believe, a couple months ago. As far as that sector, I don't think we have any intention. We are a little skeptical the way that oil companies have traditionally been managed in terms of capital allocation. So companies like GrafTech will actually benefit from higher oil prices. So I think we have that basis covered. In mining, Capstone Copper continues to be our favorite play. I don't think we've looked at any other companies that are really intriguing at the moment in that sector.
I don't have any further comments.
Great, and I think our next question that we got is going back to NVIDIA, and it is what about the possibility of them being licensed to go to China as was attempted recently?
Certainly that will affect them because they make some of the most powerful chips in the world and the most technologically advanced, and so they're affected by that. But I would also say that more than likely, I would think it will create a black market because there's plenty of individuals in other parts of the world would be willing to buy those chips and send them into China. I think it's a very, very difficult thing to attempt to do, in my opinion. Dom, do you have any questions on that? Dom does not have any further response on it. But certainly it will affect them in the short run.
Okay, and the next question we received is, do you anticipate any dividends from companies in the portfolio to grow or decline in the 2023?
I can answer first, and you guys can chime in. I mentioned in the earlier part of this call that one of the issues today is that there is a lot of excess liquidity out there, and that exists, a lot of it exists on corporate balance sheets. So we do expect dividends to continue to increase. Actually, this year, dividend growth is one thing that we look at in our portfolio, and we've had a lot of dividend growth despite markets being down in 2022. And we still see corporations with record cash holdings on the balance sheets. So we do expect dividend growth, and I might cut in on one of your answers, but we would prefer to see share buybacks in an environment like we see today, where companies' stocks are trading at significant discounts. The net effect to the shareholder in the long run is positive when a company buys back its shares, and probably preferred from a taxability standpoint as well. So we would expect to see both dividend growth and share repurchases in 2023. Peter?
We also have seen some special dividends in unusual situations. So, for example, Weyerhaeuser pays out a smaller dividend of about 68 or 72 cents per year, and then they paid special dividend late last year of 50 cents, and I believe they paid another dividend, which I think was in the about $1.50, not quite, but somewhere in that range, so that we have some special dividends in there as well. And then also we had 2 special dividends paid this year from Warrior Met Coal that are intended to be one-time scenarios of excess cash, given that in both cases the commodity that the companies sell, in Weyerhaeuser's case lumber and trees, in the case of Warrior Met is coal, we saw significant rises and had very high profitability earlier in the year. And in the case of Weyerhaeuser, the price of lumber has dropped off quite a bit. And I believe in Weyerhaeuser, with Warrior Met, the price of coal is, I believe, will continue to start declining as well. Dominick?
The only other thing I'll add is some companies turned off the dividend in 2020 and 2021 to preserve liquidity during the COVID shutdowns. Companies like Hersha Hospitality, they reinstated their dividend this past quarter as well. So there might be other companies that turned off the dividend stream to save cash, but could look to reinstate their dividends going forward.
And only because I can see we don't have any other questions at the moment. I'm going to do a shameless plug for the newsletter. In this quarter's newsletter, which just came out earlier in the week, mentioned a little analysis that I had done for a client this quarter regarding their dividend growth. And typically what we see is, we want to outpace inflation. And one of the ways that people do that when they're working is through their wage growth. Employers provide cost of living adjustments, you get raises, promotions, things of that nature. So when you're in your working years, your income is typically growing, you're outpacing inflation, increasing your standard of living. And what we want to have is a situation in your retirement where we replicate that. And dividend growth, when I did that comparison for the client, their wage growth was about 3.9% over 10 years. And it was a unique person. They had tracked their wage growth, which is kind of a cool thing. We looked at our dividend portfolio, and that dividend portfolio grew by 10% annualized. And again, the wage growth grew by 3.9% annualized. So more than doubled what that person got in terms of wage growth. So in the beginning of retirement, what we typically see is you're spending a little bit more into your principal, and dividends are covering a portion of income. But later on in your retirement, we have plenty of success stories in this regard is that dividend growth really takes over, and eventually the income stream from the portfolio outpaces the spending needs of the individual. So people who are in their late 70s, their 80s, even into their 90s, the dividend growth is so much greater than, or the dividends being paid on the portfolio tend to be so much greater than what the people need to draw from the portfolio to cover their lifestyle. So we definitely expect that to continue. It's not straight line growth, it's lumpier, but it tends to be far more resilient than the actual value of the portfolio in any given year.
All right, it doesn't look like at this time we have any other questions, so we can wait a couple more minutes for other questions coming in, and then if we don't get any, we'll end it. All right, it looks like the questions have stopped coming in. Some people are dropping off, so I'm just going to end the call for today. And as a reminder, you can send in questions that you'd like answered by our team via email prior to these calls. You can email any member of our team with your questions, and we'll be sure to address them on the call. Thanks for tuning in to our commentary on the market and your investments. You'll be able to replay a recording of this call within 24 hours on our website or our YouTube channel. Thanks again for joining.